So, you've been told you need to invest for your future. You decide to get serious. You start looking into it, and bam, you're hit with a wall of confusing terms. Mutual funds, index funds, expense ratios, active management. It feels like you're in the middle of a financial battle royale with 1,000 options all screaming they'll make you rich. But what if I told you that for most people, the choice is actually incredibly simple? What if the real secret to building wealth wasn't about being some stock-picking genius, but about making one simple, almost boring decision correctly? In this guide, we're putting index funds and actively managed mutual funds in the ring for a head-to-head showdown. We'll compare them on the only three things that actually matter: the fees that quietly eat your returns, real-world performance, and the sheer simplicity of getting started. What are these funds, anyway? Before we pit them against each other, let's demystify what a fund even is. Imagine you want to buy stocks in companies like Apple, Microsoft, and Amazon. Buying one share of each could cost hundreds, maybe thousands of dollars, and if one of those companies has a bad year, a big chunk of your investment is in trouble. Now picture this. You and 1,000 other people all chip in a little money to one giant pot. With that massive pool of cash, you can buy not just 3 stocks, but hundreds or even thousands. That's the core idea of a fund. It pools money from tons of investors to buy a diversified portfolio of stocks, bonds, or other assets. You're no longer betting on a single horse, you're betting on the whole race. This built-in diversification dramatically lowers your risk. A single bad stock won't sink your entire portfolio. Both index funds and mutual funds are these baskets of investments, but how the investments inside that basket are chosen is where they take completely different paths. This is the most important distinction. Think of an actively managed mutual fund as a restaurant with a celebrity chef. This chef, the fund manager, is hand-picking every single ingredient, claiming their expertise will create a meal far better than anything else out there. They're always in the kitchen, tasting, tweaking, swapping out ingredients, all trying to create a masterpiece. Their goal isn't just to make a good meal, it's to beat the market. An index fund is like a community kitchen that perfectly follows a classic, time-tested recipe. Think of the S&P 500, which is just the 500 largest companies in the US. There's no celebrity chef. If the recipe says add 7% apple, the fund holds 7% apple. If the recipe changes, the fund changes with it. Its goal isn't to be fancy, it's to match the market's performance, not beat it. This one difference, the active chef versus the passive recipe follower, is the key to everything. The head-to-head battle: fees, performance, and simplicity. Round 1. Fees, the silent killer of your growth. This is the most important round. Every fund charges a fee called an expense ratio, a percentage of your total investment skimmed off the top year after year. It might seem small, but its effect over time is devastating. That celebrity chef? They're expensive. Active managers and their research teams demand high salaries, and all their buying and selling costs money. Actively managed mutual funds often have expense ratios between 0.5% and 1.5%, sometimes even higher. Index funds are incredibly cheap to run. Since they just automatically track an index, there's no need for a high-paid manager. Their expense ratios are dramatically lower, often ranging from just 0.02% to 0.20%. You might be thinking, a 1% difference, what's the big deal? Let's put it in perspective. Imagine you invest $10,000 and the market returns 8% per year for the next 30 years. In an actively managed fund with a 1% expense ratio, your net return is 7%. After 30 years, your $10,000 would grow to approximately $76,122. Now put that same $10,000 in a low-cost index fund with 0.1% expense ratio. Your net return is 7.9%. After 30 years, your $10,000 grows to approximately $100,227. That is a difference of over $24,000. You lost nearly 2.5 times your initial investment just for fees.
That 1% fee didn't just cost you a little each year, it cost you all the growth that money would have generated for decades. As John Bogle, the legendary founder of Vanguard, famously said, "In investing, you get what you don't pay for." When it comes to fees, this isn't even a close fight. Winner of round 1, index funds, by a knockout. Round 2, performance and risk. Can the chef actually beat the recipe? Mutual fund managers argue their high fees are worth it because their expertise will help them beat the market. They promise to pick the winners and dodge the losers, delivering higher returns than a simple index fund. It sounds amazing in theory, but what does the data actually say? This is where the SPI-VA report comes in, the official scorecard for the active versus passive debate. For over 2 decades, it has tracked how well active managers do against their benchmarks. The results are staggering. Over a 10-year period, the overwhelming majority of actively managed funds, often over 90%, fail to outperform their benchmark index. One recent report found that 84.3% of large-cap U.S. funds underperformed the S&P 500 over the previous decade. Let that sink in. You are paying a premium for a star chef who more than 9 times out of 10 delivers a meal that's worse than the simple, cheap recipe everyone already knows. And the few managers who do win in the short term almost never do it consistently. The longer you look, the worse the record gets. This isn't an opinion, it is a statistical reality. Even Warren Buffett, arguably the most successful investor of all time, consistently advises everyday investors to just buy a low-cost S&P 500 index fund. He argues that when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Mutual funds also add manager risk. Your returns depend heavily on the skill of one person or a small team. If that manager makes bad bets, retires, or leaves, your investment could suffer. An index fund has no such risk. It just follows the market. Winner of round 2, index funds. Round 3, simplicity, the set-it-and-forget-it factor. For a beginner, simplicity is a feature, not a bug. Investing should be a background task that supports your life, not a second job that consumes it. Index funds are the definition of simple. Your entire strategy could be this: open an account at a low-cost brokerage and regularly buy a broad market index fund that tracks the S&P 500. That's it. No analyst reports, no daily market watching, no worrying if your fund manager is losing their touch. It is the ultimate set-it-and-forget-it strategy. Choosing an actively managed mutual fund, though, that's work. You need to find one of the rare managers who might beat the market over the next decade, research their history, understand their philosophy, read dense legal documents, and then constantly monitor their performance. It's a ton of work for a very low chance of a payoff. Active funds can also create tax headaches. Because managers are constantly buying and selling, they generate capital gains that get passed on to you. You could get hit with a surprise tax bill at year-end, even if you never sold a single share. Index funds, with their low turnover, are generally far more tax efficient. For anyone who values their time and wants a clear, straightforward path, the choice is obvious. Winner of round 3, index funds. After 3 rounds, the verdict is in, and it's a clean sweep. For the vast majority of beginners looking for a simple, effective, and low-cost way to build wealth for the long term, the clear and undisputed winner is the index fund. They dominate on fees, keeping more of your money working for you. They win on performance, where decades of data show that passively tracking the market beats most high-fee managers. And they win on simplicity, offering a set-it-and-forget-it approach that cuts out the complexity and the guesswork. The world of investing can seem overwhelmingly complex, but a winning strategy doesn't have to be. It doesn't require secret knowledge or rare stock-picking talent. For most of us, building real wealth is simply the result of consistently saving and investing in a simple, diversified, low-cost way. By choosing an index fund, you're stepping off the hamster wheel of high fees and chronic underperformance. You're aligning your success with the long-term growth of the market itself and putting yourself on a proven path to financial freedom. The battle between index funds and mutual funds has a clear winner for beginners, and now you have the knowledge to make the right choice for your money. How to get started in under 10 minutes. So, how do you actually do this? It's way easier than you think. Here is your simple 3-step plan to start investing in index funds. Step 1. Choose a brokerage. This is just the company where you'll open your investment account. For beginners, the best choices are Webull, Robinhood, and Wealthsimple in Canada. They're all reputable, offer a huge selection of low-cost index funds, and make the process incredibly easy. Step 2. Open an account. You can do this online in a few minutes. A great place to start is a tax-advantaged retirement account, like a Roth IRA in the US and TFSA in Canada. In these accounts, your investments grow completely tax-free, and you won't pay any taxes on withdrawals in retirement.
Step 3. Choose your fund and start investing. Don't get paralyzed by choice. A broad market index fund that tracks the S&P 500 is a great starting point. Popular examples include Vanguard's VOO, Fidelity's FXAIX, or Schwab's SWPPX. You can start with any amount, even just a few dollars. Set up automatic recurring investments, even $50 or $100 a month, and let the system work for you. The most important thing is to start and stay consistent. The world of investing can seem overwhelmingly complex, but a winning strategy doesn't have to be. It doesn't require secret knowledge or rare stock-picking talent. For most of us, building real wealth is simply the result of consistently saving and investing in a simple, diversified, low-cost way. By choosing an index fund, you are stepping off the hamster wheel of high fees and chronic underperformance. You are aligning your success with the long-term growth of the market itself and putting yourself on a proven path to financial freedom. The battle between index funds and mutual funds has a clear winner for beginners, and now you have the knowledge to make the right choice for your money.